Ladies and gentlemen, good day and welcome to the Home First Finance Company India Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Manish Kayal. Thank you, and over to you, sir.
Thank you, Mike. Good afternoon, everyone. I hope that all of you and your families are safe and healthy. I am Manish Kayal, and I look after investor relations of Home First Finance. I extend a very warm welcome to all the participants on our Q1 FY23 financial results Concall. Today on the call, I am joined by our MD and CEO, Mr. Manoj Viswanathan, and CFO, Mr. Nutan Gaba Patwari. I hope everybody had an opportunity to go through our investor deck and press release, which we uploaded on exchanges and our website yesterday. We have also uploaded the Excel version of our fact sheet on our website and request you look. With this introduction, I hand over the call to Manoj. Over to you, Manoj. Thank you.
Thank you, Manish. Good afternoon, everyone. We are pleased to showcase the strong business momentum that we are seeing in our business. FY22 closed on a strong note, and quarter one of FY23 is also displaying the same trend. I will take this opportunity to share the highlights of the quarter with you. During the quarter, we disbursed our highest ever quarterly number of 661 crores, which is an increase of 3.1% on a quarter-on-quarter basis and 117% on a year-on-year basis. Our AUM at 5,832 crores is up by 8.4% on a quarter-on-quarter basis and 35.8% on a year-on-year basis. On asset quality, there is further improvement in 1 plus and 30 plus DPD levels. 1 plus DPD improved 5% from 5.3%, and 30 DPD improved to 3.5% from 3.7%. Our gross stage 3 stands at 2.1%, which is down 20 basis points from 2.3% in March 22. This includes 444 million, that is 0.90%. Which is currently in buckets that are less than 90 DPD, but they have been included in NPA due to the asset reclassification norms as per RBI notification dated 12 November 2021. Adjusted for this, the number stands at 1.2% in June 22, and this is down from 1.3% last quarter, an improvement of 10 basis points. During the quarter, the rating on our long-term credit facilities were upgraded to AA- stable from both ICRA as well as CARE ratings. This is in addition to the AA- stable rating assigned by India Ratings on our long-term credit facilities in March 22. So this upgrade is a testimony to our strong risk processes, asset quality and strength of the balance sheet, and also highlights the economic and sectoral recovery from COVID and the overall housing sector. We are also pleased to report that during the quarter we have done the first transaction under the co-lending tie-up with Union Bank of India. The AUM amount of this co-lending transaction is 9.65 crores and the amount transferred to Union Bank is 7.7 crores. This quarter we opened 13 physical branches, taking the overall number to 93 from 80 in March 22, and the total distribution points have gone up to 224 from 200 in the same period. This is in line with our plan to reach 400 distribution points in the next 2 years. Digital adoption has further improved. Registration on the customer app are up at 84% compared to 80% last quarter and 67% a year ago. Service requests made on the app in quarter 1 FY23 have gone up to 87% compared to 75% a year ago. The 48-hour turnaround time for loan approval also continues to be high at 90% in this quarter. Our e-onboarding initiatives have again progressed further with e-stamp adoption at 57%, e-NACH adoption at 60%, and e-sign in 40% of the cases in quarter 1. With this, I will now hand over the call to Nutan to take you through the financials. Nutan, over to you.
Good afternoon all. I will take you through our financial performance in quarter 1 FY23. We continue to stay focused on our key operating metrics with an intention to deliver mid-teen ROEs in a couple of years. Our net interest margin is stable at 6.4% even in the increasing interest rate environment. Spreads have increased by 20 basis points on a quarter-on-quarter basis, but it was offset by increasing growth and cash position. Net interest income has gone up by 49.8% on a YOY basis and 9.2% on a QOQ basis. We did direct assignment of 80 crores during the quarter as a liquidity strategy. We continue to have robust demand for our portfolio of assets. OpEx to assets stands at 2.9% for the quarter. As guided earlier, we expect this ratio to remain in the range of 3 to 3.2% going ahead as we focus on expansion. Cost to income at 35.8% in Q1 FY23 was flat on a QoQ basis. Q1 FY23 PPOP stands at 70 crores, growth of 6.1% on QoQ and 15.2% on a YoY basis. Credit cost at 0.3% is within our expected range. Our ECL provision stands at 1% of the total principal outstanding. We continue to be conservative with the provisions. Total PCR stands at 45.8%. Prior to NPA reclassification as per RBI circular, PCR stands at 81%. Our adjusted profit after tax of 51 crores grew by 6.4% on a QoQ basis and 46% on a YoY basis. Moving to liquidity and borrowings, as Manoj mentioned, both ICRA and CARE Ratings have upgraded our long-term credit facilities to AA- with stable outlook to our long-term rating in this quarter. The company continues to have diversified and cost-effective long-term financing sources. During the quarter, we included Qatar National Bank and South Indian Bank as our new banking partners, and we continue to work towards further diversification. We have a healthy borrowing mix with 47% of borrowings from banks, public sector 22% and private sector 25%. 25% from NHB refinance and 22% from direct assignment. We continue to have zero borrowing through commercial paper. Our cost of borrowing is lower at 6.9% from 7.2% on a QoQ basis. This is due to drawdown of NHB funding in March 22. Our marginal cost of borrowing for quarter one was 7.7%. During this quarter, we have not availed any new NHB borrowing. Moving to capital, our capital adequacy is at 52.3% and Tier 1 is at 51.8%. Our June net worth stands at 1628 crores versus 1574 as on March 22. Our quarter ROA is at 3.9%. Our annualized ROE stands at 12.8% on Q1 numbers versus 11.8% in FY22. Our book value per share stands at 185.7 as of June 22. With this, I open the floor for questions and answers. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Karthik Chellappa from Buena Vista Fund Management. Please go ahead.
Yeah, hi. Thank you for the opportunity and congrats on the great quarter, team. I have 3 questions. The first one is, what drove the sharp reduction in the Tier 1 ratio in the first quarter? It's down, I think, almost 58% to like 51.8% this quarter on a quarter-on-quarter basis.
Sure, Karthik. So the way capital adequacy is computed, it has risk weights against different assets. So we have some investments on the treasury side in liquid funds and overnight funds, which get categorized at 100% risk weight, versus if you place money through FDs or T-bills, which get categorized at 0%. So that is the reason why this is looking like a sharp reduction. If we made an assumption that it was like quarter 4 where we kept money in FDs or in bank balances, then the number would be 56% and not 52%.
And what exactly is the nature of these investments that you have done, which necessitate a 100% risk weight?
These are liquid fund investments, the classic investments which are out for 17-18 days. That's the tenor that we look at.
Got it. I mean, so from here, similarly, for the next quarters, we shouldn't expect a similar reduction in tier 1, right? This one-time reduction was probably just a shift in allocation, right?
Absolutely. From here on, it will be largely linked to growth.
Okay, largely linked to growth. Okay, got it. The second question is a slightly medium-term question to basically Nutan and Manoj. If I look at the industry as a whole, right, specifically HFCs and NBFCs, and if I look at their annual reports, the attrition rate has actually been rising, whether it is for yourself, I think you are at about 36-37%, Aavas is at north of 40%. So across, we are seeing a rise in attrition. And I also noticed that the median remuneration increase for non-managerial staff last year was something like about 8 or 9%. So with inflation rising and with such a high attrition, from a medium-term perspective, how are you thinking of improving your staff retention?
Karthik, this is a ongoing, you can say, execution challenge in this industry. And there are phases when it's a little higher, some phases when it's slightly lower, etc. But generally, the front-end attrition rate, even in the best of times, is in the region of 25%, 20-25%. So the 35% rate which you're talking about is also inclusive of you can say people who joined, left immediately, did not fit in, it's not their line of work or the kind of work they want to do, etc. So it consists of all profiles of such people. So generally it's a 10% range, 25 to 35% is generally the range which is there. Of course, post-pandemic, I think there was a phase, or there is a phase when the attrition has increased a little bit. But I think we are you can say working towards various ways in which we can improve that number. So one way is to, for example, at the hiring level itself, increase the or improve the communication in terms of job profile, etc. So we are taking various steps to see how we can address the attrition levels. But generally, it's going to be range bound in that range.
And would it be reasonable to expect that a double-digit rise in pay raise is now going to be the order of the day, at least for the next 2 to 3 years, as everybody aggressively builds out their branch network, etc.?
So we have, from a pay increase perspective, we have always believed in kind of, building our own team and hiring less from the market to that extent. So generally, when you hire from other companies, or if it's a lateral hiring, then the offers are what do you call it, more aggressive, or we need to make more aggressive offers to attract people. But we have always believed in building our own team. So we hire from campuses. So a very large proportion of our hiring is from campuses, and then we groom them and help them to kind of develop within the organization by giving them more responsibilities. We have a fairly wide coverage of ESOPs as well. So once a person spends a couple of years, they get covered by ESOPs. Once they move into a kind of supervisory role. So that also helps us to retain people. So we have a very good coverage of ESOPs. If you look at our current ESOP coverage, it's almost 300 people in the organization have ESOPs in 800 to 900 member organization. So 25 to 30% of the population has ESOPs. So our people management strategy in that sense is slightly different, and that's how we are looking at addressing this wage inflation issue.
Got it. My last question, Manoj, is if I look at the incremental yield, loan yield this quarter, it's crossed 13% already, 13.2. And with more interest rate hikes on the way, possibly this also is going to go up. But given that you have a disbursement target of 25-30%, how much more rate hikes do you think the industry and your customer set can take without impacting growth?
See, there is, I mean, the affordable housing, if you see the spectrum of affordable housing and the rate, range of rates in the market, it ranges, it's a very broad range. Right from, let's say, at 11% to, there are players operating even at 18%. To that extent, there is enough absorption capacity in the market. So if, for example, let's say the 13% category of customer is declining the loan because the rates have gone up slightly, then there is a 13.5 type of customer or a 14% type of a customer who's available in the market, and who's interested in taking the same loan. So there is absorption capacity, and as of now, it looks like the rate increases will be very gradual. We feel that and we are not seeing an impact, at least last 2-3 months, we are not seeing any impact of these little rate hikes in the market in terms of impacting demand. So we are fairly positive on that front, that it's not going to impact demand in a big way.
Got it. That's it from my side. Thank you, Manoj, Nutan, and Manish. Wish you and the team all the very best for the remaining quarters.
Thank you.
Thank you. We have the next question from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. Can you share the percentage of disbursement which is coming from self-construction in the quarter, and what is the number on AUM?
So incremental numbers coming from self-construction, that is pure self-construction, that is the people with a plot who are building homes, will be about 40 to 45%. And this obviously does not take into consideration, individual contractors building homes, selling to customers, resale transactions, etc. So those are separate. This is purely people who are building their houses on their own.
And what would be this number on AUM? I'm trying to understand, incrementally, are we seeing increase in this share of self-construction?
On the AUM, it will be slightly lower. It is about 30% because this business started a little later than the apartment business. So on the AUM, it's about 30%.
Sure. Secondly, in terms of tech, that has been a differentiator for us. But in last 1 year, we have seen one large HFC also adopting Salesforce. A couple of affordable housing finance players, I think, also are trying to replicate our model. So in that context, how we stay ahead in the game from our next 2 to 3 year perspective? How are you thinking of improving on our existing processes and existing infrastructure?
We have to apply a mind on how we can continue to stay ahead. What we adopt today, it's not very difficult for people to copy it after within a few quarters. So we have to continuously think on what technologies will be applicable to us and what will be relevant to the customer and how we can adopt it, and stay ahead. Having said that, it is not only about the technology; it's also about the business processes that support technology and vice versa. So, for example, if we are adopting a certain technology in the process, the way the actual physical flow of documents, physical flow of the business also needs to kind of be designed in a way which which can work in sync with the technology. So that's also, that's a mindset and that's a design, a thinking, process also that we adopt. So it's not just technology in isolation. It's also about how the teams work together and how the whole process is designed.
Thank you. That's it from my side.
Thank you. We have the next question from the line of Abhijit from Sundaram Mutual Fund. Please go ahead.
Thanks for taking my question. Congratulations on a very good set of numbers, sir. I have 2 questions. First one, there is a consistent positive surprise on NIMs. if you can talk, even as per management's own estimates, I think NIM was supposed to moderate. If you can talk about how you're seeing the trajectory of NIM and also combine it with cost of funds in the light of recent rating upgrade, whether it will be a yield decline, as in passing on the benefit to the customers, or you see cost of funds, sort of inching up for you. What scenarios will play out? That's the first question. Second question is on DA income. This particular quarter, you have done quite well on ROA and PPOP growth, despite DA income coming off. How does it look for the rest of the year, especially because the demand seems to be quite good for direct assignment, etc. So yeah, these two are the questions.
So on the NIMs and ROI, the transmission has not been, has not really taken place fully. It has started, to some extent, cost of borrowing is kind of moving up. But the full transmission of the repo rate increase, etc., has not happened yet, and we are also passing it on, only to the extent that we are, that it is impacting us. Which is why you would not have probably seen, any change in the NIMs, and so while we had mentioned that yes, it's the NIMs will moderate a bit, it's not yet happened. But yeah, what we are saying is that once the full transmission happens, then we should be looking at a 5.25 kind of a spread, and then corresponding minor moderation on the NIMs. As far as the DA is concerned, I will request Nutan to address that.
Sure. So on the DA income, the reason for doing a low DA is, primarily because from a liquidity standpoint, we did not look at a larger amount, and that's why we decided. You're absolutely right that the demand from a DA perspective, given that it is an attractive PSL asset, is very, very good. So not an issue on that side. Also on the cost of borrowing, your question around how does this look going forward. So cost of borrowing has largely two components. One is the marginal cost of borrowing. Now, subsequent to our rating upgrade, we have been able to discuss reasonably. We have diversified our lender base even further, and we continue on that journey. Secondly, post our rating upgrade, we are able to discuss and engage with banks to reduce the credit spread further. So which is why you see the marginal cost of borrowing also in quarter one is around 7.7%, and hopefully remains in similar range in quarter two also. So that is one part of the cycle. The second part of the cycle is on our existing borrowings, the increase coming from the repo impact via the MCLR reset over the year. So that we expect to inch up gradually. So once all of that sets in, we do see some kind of a compression, and that's what we've been kind of indicating. Whether that full compression gets translated in quarter three or quarter four, it probably will be around that time.
So just to clarify, the income recognized on DA will come back to what you reported in the last year from Q2, right?
So we are, our strategy to do DA is approximately 100 crores plus minus. So we will remain in that range, Abhijit.
Right, sure.
100 crores per quarter.
Right, got it. Sure. Thank you.
Thank you. We have the next question from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening, and thanks for taking up my question, and congratulations on a very good set of numbers. So firstly, on the OPEX front, your cost to assets were around 2.7% in FY22, and given the expansion plans in this fiscal, how do you expect this ratio to evolve for FY23?
Right. Mona, for 2.7% was there in last quarter, it was around 3%. And we've been indicating a number of around 3 to 3.2%, given that we do branch expansion, we add people. Also, we've given increments effective April. So with the combination of increase in variable spends and also leverage from our fixed spend, we are looking at a 3 to 3.2% range for the rest of the year.
Sure. And on the margin front or spread front again, so Manoj just mentioned that, post full transmission, we could see a spread of around 5.25%. So is that fair? Is it fair to assume that, we'll not be able to pass on the entire rate hike to our borrowers? The cost of fund hike rose, given that we did not pass it on in the down cycle as well?
Yeah, just as a fair practice, since we have not passed on the full benefit, we are also looking at, absorbing some of it. But we'll have to see how it plays out and how much the real transmission or the total transmission is. And we will take a call on that basis.
Sure. And just two data keeping questions. So what were the write-offs during the quarter and cumulatively, if you can share, and what's the restructured outstanding book?
So the write-off for the year, there are two parts. There is a small technical write-off around 3 crores and residual write-off around 1 crore. So that's the write-off number.
For the quarter?
For the quarter, yeah. And for restructuring is around 26 crores. Outstanding. 26 crores is the outstanding.
Okay. Against 28 crore last quarter.
That's right.
Okay. And cumulatively also, if you could share the write-off over the years, how much have we written off?
We'll have to come back to you, Mona.
Sure. Thanks. That's all from my side. And all the best.
Thank you. We have the next question from the line of Amit Ganatra from Invesco AMC. Please go ahead.
Question from my end. You mentioned the marginal cost of funds was around 7.7. What was the marginal yield?
13.2 for quarter one.
That's like incremental yield, right?
Yes.
Yield.
Yes.
13.2 against the book yield of?
12.8, just 12.7, I think. 12.7.
Okay, understood. Okay, I'm done. Thanks.
Thank you. We have the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hello, sir, and hello, ma'am. Congratulations on great set of numbers. And thank you for giving me the opportunity. And my question was, firstly, like in the last 2 quarters, we've added branches, especially in the state of Tamil Nadu. So there we've taken the highest number of additions. So any particular thought process? Is it because that some of the companies operating there have relatively higher spreads? And so is that the thought process, or if you could throw some light, what is the idea behind it?
Yeah, sure. So, see, increase in distribution, both the physical as well as the virtual distribution. We are basically looking at it from the certain set of states that we have identified where business is strong and demand is strong. So if you look at overall affordable housing demand in the country, so Gujarat comes up on top of Gujarat and Maharashtra, and then followed by Andhra, Telangana put together is comes third in terms of size, and then it's Tamil Nadu. So we are just going purely by size of market. These are very large markets for affordable housing, and hence we are just strengthening our distribution in these markets. There's nothing else other than that to it.
Okay, got it, sir. Also, the second question was with respect to the in the floating and fixed rate, the book that we have with respect to floating and fixed rate. What would be the split there? And do we have anything like floating, a book which is in floating bucket, but would be fixed for say 2 to 3 years sort of a bucket? So it gets reset after every 2 to 3 years.
No, so see, effectively the entire book is floating for us. And the reason we say there is a fixed portion is because there are certain schemes, NHP schemes, where we are supposed to offer a fixed rate to the customer. But those those loans are also at the back, supported by a fixed rate loan to us from NHB. So effectively, there is no interest rate risk on those loans. So which is why, effectively our entire book is floating. As in we can reprice at any point.
Okay, got it. So one last question with respect to the cost of fund. So the reported number is 6.9%, but this will also include the assignment that we would have done. While it is low, but still it would include, right?
No, it will not include. This is the cost of borrowing on the on-balance sheet borrowing.
Okay, got it. Thank you, ma'am. Thank you so much. And one last question on this, if I can squeeze in. So on the branches side, so what number of branches would be having an AUM of, say, more than 120 crore? So which would be mature as per our standards?
For 20
120 or 125 sort of a crore. I think that's the parameter for us to consider.
Yeah, 20. I'm saying 20 branches, around 20 branches.
And what number of branches would be, say, below 50 crore?
Below 50 crores is about 50 branches. 50 to 60 branches.
Okay. Thank you, sir. And good luck for the next quarter, sir. Thank you so much.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Pooja Ahuja from Monarch Network. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on the number. Congrats for the quarter. So just wanted to ask firstly, if I look at the absolute NPA number for the last 3 quarters, it's been at somewhere, 100 odd crores. If you could just give a breakup of how much of this would be in the 90 plus bucket and in less than 90 bucket.
Yeah, so that number is 44 and 56, 58. So 44 crores is below the NPA bucket. But it has, these are cases which have crossed into NPA, at some point. So they have to be reported as NPA. So that is 44 crores. And what is actually in NPA is about 58 crores.
So both the numbers, if I look at compared to the previous quarter, it's been quite sticky. So what would you attribute this to?
So inflows, so it's basically inflows are equal to outflows. So we have resolved about 20 crores and 20 crores have come into NPA. And this number will trend down basically, as the earlier buckets also trend down. So which is trending down gradually. So 5 point, 1 plus reduced from 5.3 to 5. And 30 plus has reduced from 3.5 to 3.3. So that as these buckets reduce, the flow into the NPA also will keep reducing. See, because now we are, if you look at it from a pre-RBI classification number, we are at 1.2 in terms of the NPA. So which is very close to the pre-pandemic number. So at these levels, the improvement will be gradual going forward.
Okay. Sure, got it. And on the, we've seen disbursement growth consistently increasing every quarter. So where is this demand coming from? Is there any particular geography that's doing well, or is it across?
Demand is coming from across, and it's also a function of where we are adding distribution. We are, as per our strategy, we are adding distribution in the 6 states that we are focusing on. Which is Gujarat, Maharashtra, and the southern states. So that's where the growth is also coming from. In the other states, we're not adding as much distribution.
Sure. Okay. Yeah, that's it from mine. Thank you.
Thank you. We have the next question from the line of Jigar Jani from Edelweiss Broking. Please go ahead.
Yeah, hi. Thank you so much for taking my question and congratulations for a great quarter. Couple of questions. So your incremental yields over the last 2 quarters have been inching up. So last quarter it was 13%, this quarter it is 13.2. So how long will it take to reflect in the overall yields? Because actually the yields have come down this quarter if you look on the book. And a related question to this is, when you say that your floating rate book, your entire book is floating, how much of that is linked to an external benchmark and how much is MCLR?
Yield, the rate at which we are originating, when it will reflect in the book, it should reflect over a period of 6 months to a year. But the issue is that every year there is some portion that goes into NHB, refinance schemes, where the rates also get reset. So the way we draw down these NHB schemes is that we reset the rates for existing customers, wherever there are rate caps, which are required by NHB, and we draw down under those accounts. So as a result of which the overall portfolio yield gets subdued to that extent. From April till about December, you will see that slowly the yield, the book yield is trying to catch up with the origination yield. But then again, we have a large, you can say, a drawdown of NHB, and then the book yield reduces slightly. So that's that's how the mechanism works. And I think that was the question.
Yeah, and so when you calculate your incremental yield, that does not include yields on the NHB book. Is that what you're saying?
But what we are reporting is the overall yield, including NHB, including the NHB loans. So, which is why when you're seeing it, it's looking lower than the origination yields.
Okay.
Because origination yield does not have any NHB component.
Okay, understood. And how much of your floating rate is linked to like a repo or any other external benchmarks?
It's basically linked to our, so it's basically linked to our borrowing cost, and so of which I think about 4-5% is linked to repo, and the remaining is largely linked to MCLR.
Sorry, I didn't get the number. Can you just repeat that number?
About 5% is directly linked to repo, our borrowing.
Okay, understood. And last quarter, you had said that out of GNPA, which is the 44 crores, which is not 90 DPD plus, but it has to be classified as per RBI into this category. You cannot initiate SARFAESI on that. Is that still holding true? Because one of your peers had actually mentioned in the call that they have been able to initiate SARFAESI. So will that normalize only when the customer pays back?
We are taking the stand that these are customers. First of all, this number is large. The difference between the pre-RBI and post-RBI number is kind of wide at this point, only because of we are attributing it largely to COVID-related impacts. Right, so these are customers who had some impact due to COVID and could not pay for a couple of months, went into NPA, and then now they're trying to catch up. And the catch up is taking time because these are customers who can't pay more than an installment every month. So we have to collect partial amounts and make good and come back to normal. So it takes a few months. So given the situation of the customer and their you can say keenness to retain the property and continue the loan and become regular, we ourselves think that a SARFAESI action would not yield good results, and it's not fair. So we have really not attempted it in that sense. Our attempt is to only collect partial installments and bring these customers to normalcy.
Okay, great to hear that. Thank you so much for that. That was all from my side. Thank you, and best of luck.
Thank you. We have the next question from the line of Dipanjan Ghosh. Please go ahead.
Hi, am I audible?
Yes.
Yes, we can hear you.
Yes. Just two questions from my side. One is if you can give some color on the customer waterfall in terms of origination or logins to disbursements, and how that has changed, let's say, compared to the last quarter during pandemic and pre-pandemic. And second is a data keeping question, if you can mention your BT out number for the quarter.
So if you look at, let me just take you through the, or walk you through the origination funnel. So if we have about 100 this is the origination funnel, for channels that are directly handled by the branch, so builders, connectors, etc. The origination funnel for digital channels is a little different. I'll take you through that separately. So generally, if 100 leads come through from a connector or from builders, about 60 to 70% of it, you can say about 30% gets rejected or declined upfront. 60 to 70% goes through. 30% gets declined upfront for primarily bureau-related reasons or because the customer cannot afford in his budget. The loan doesn't fit into the budget. So out of let's say 70 loans which come into the system, say about 50 would be finally approved, by our centralized credit team. So broadly the ratio is 50% approval for field-based channels. For digital channels it's very different. So if 100 leads come in, generally the conversion itself is less than 1%. So probably one customer would finally get converted into a loan. 99 customers would fall into various buckets. About 30-40% of them would be declined as because they're not eligible or there's a bureau related issue. Another 30 to 40% would be casual inquiries where people are not really interested in taking the loan. They were inquiring and so on and so forth. So finally it boils down to 10 interested customers out of 100, and out of which we generally convert one. So that's a different funnel altogether as far as digital channels are concerned.
So Manish, if you can just follow up on this, has this 50% sort of odd number on a blended basis changed, let's say over, pre-pandemic, during pandemic, and as of today?
Not really. I mean, the ratios, at least pre-pandemic and now, it's fairly similar. And if you look at it during pandemic, it was not significantly different. I mean, because people who were coming through the door were only customers who were, let's say not greatly impacted by the pandemic. So to that extent, the decline ratio, etc., was similar. Somebody who was badly impacted by the pandemic was not even applying for a loan at that point of time. We have not seen much difference, frankly speaking.
Sure. And if I can just have the data for BT out during the quarter.
BT out was about 5.6% this quarter.
Sure. Okay. Thanks and all the best.
Thank you.
Thank you. We have the next question on the line of Shirish Vaz from Money Life Advisory Services. Please go ahead.
Thank you, sir, for giving me the opportunity. My first question is regarding CRAR and ROA. So in the opening remarks, it was mentioned that we are targeting mid-teens ROE. So in this journey, how do you see our CRAR and ROA shaping up going forward? Thank you.
CRAR, we currently set about 50% levels, and it will be some time or quite a long time before it even comes close to the regulatory cutoff. So we are comfortable as far as the capital is concerned. As far as ROE is concerned, we are making gradual improvements, and we're also trying to balance it out with, you can say, our requirement for investment at this stage. For growth, for future growth. So basically, we are looking at hitting our 14-15% in about a 2-year time frame. So that's what we are looking at.
Got it, sir. Secondly, as a majority of our loans have been originated in the last 4 years, wanted to understand how is the NPA picture across our loans with older vintages. Are the numbers higher or lower than our aggregate NPA ratios currently?
No, so we plot vintage charts to understand how recent portfolios are performing vis-a-vis the older ones. So that's a regular exercise in our risk management process. Unfortunately, because of 2 waves of COVID, those charts are completely it's the charts are impacted because of these two waves of COVID. So the figures are, not consistent or not, you can say you can't read much into it or, derive any insights from it. So having said that, at least as far as early delinquencies like, 6 MOB, 9 MOB are concerned, they are fairly in line with, pre-pandemic levels. So, so we are comfortable from that perspective.
Got it, sir. So just lastly, just a suggestion, if in our investor presentation going forward, once the situation normalizes, we can introduce this information by dividing our loan book across vintages and showing the NPA picture, because as our portfolio is not highly seasoned because of our high growth, that would be more informative in understanding the NPA picture going forward. Thank you.
Okay.
Thank you. I will get back into the queue.
Thank you. We have the next question from the line of CG Philip from Mirae Asset. Please go ahead. Mr. Philip, can you hear us?
Am I audible?
Yes, we can hear you now.
Yeah. Thanks for the opportunity and congrats on a good set of numbers. So two questions from my end. Firstly, on the incremental yields of 13.2% we had this quarter, how much would be coming from the lab book, because the lab book has proportion has increased this quarter?
So out of 13.2, about 30-40 basis points will be coming from lab book. 30 to 40 basis points.
Okay, and you said about NIM moderation, but since we are anyways planning for a higher proportion of our lab going forward, do you expect that, that moderation would be limited?
We are not looking at a very sharp scale up and increase in lab. It's a very gradual increase that we are contemplating. So to that extent, difficult to, and we don't want to, rapidly scale up lab to compensate for any moderation that might happen in the medium term.
Okay, and my second question is, as we expand into different states, would the risk assessment profile be different, since it could include more of independent houses or plots rather than just apartments that we are currently doing much of? So would there be a change in the risk assessment profile?
Not at this juncture. I think that journey is something that we have crossed in the last 4 or 5 years. So when we started the self-construction business almost 7 years ago, yes, there were some differences in the way we were assessing apartments versus self-construction cases. But we are 7 years into that journey, so we are fairly well versed with that process. And when we look at markets, the self-construction business is largely there in the southern markets, and if you look at western markets like Gujarat, Maharashtra, it consists of more of apartments. So to that extent, each market has a characteristic, and we have you can say fair amount of experience now in each of these markets. So we can say going forward, not too many new things that we are coming across.
Right. So coming to that, since our legal and technical aspects are basically outsourced, right? So do we have a separate legal and technical team for each of these geographies?
No. So these are lawyers, local lawyers, as well as architects or engineers whom we have, you can say, contracted in those places. So we have a service provider agreement with them, and they provide these services to us. So each market, each city would have set of lawyers and valuers who have an arrangement with us. And apart from that, we also have a central team which vets their reports. So the legal or the technical report also is vetted by an internal legal technical person or underwriter who will look at the report and formulate their own opinion. So it's a two-step process.
Yeah, that's it from my end. Thank you.
Thank you. We have the next question from the line of Abhijit from Sundaram Mutual Fund. Please go ahead.
That has continuously coming down. Is it something to do with your LGD calculations? Otherwise, it was hovering around 25.
Sorry, I think the first part of your sentence was even cropped off.
The coverage on stage 3, it is continuously coming down. It used to be 25-30%. Now it is 22.5% in Q1 FY23. So is it something to do with your LGD assumptions? Can you please elaborate? And what is the comfortable coverage ratio as per you?
So it is a combination of the LGD. Also, like I was mentioning in the call earlier, we have taken a technical write-off of around 3 crores against which we had some provisions. So when we reverse that, optically it looks low. So right now we are at a comfortable provision coverage ratio on a stage 3 basis. And as we continue to improve our credit numbers, we will look at if we need to rationalize it further. But right now we are very comfortable with the overall ECL situation.
It's a function of the composition of the portfolio and the respective losses that those cohorts are giving us. So it's a derived number.
Got it. Sure. Thank you. That was the only question.
Thank you. We have the next question from the line of Sharaj from Laburnum Capital. Please go ahead.
Hello. Am I audible?
Yeah, Sharaj.
Thank you for the opportunity, sir. So my question was around BT. So our rates are around 4 to 5%, if I'm correct. So what percent of our customers actually approach us with BT offers? I mean, in the past you said you'd actually counsel your customers to stop BT, to move away from the offers. But what percent of our customers approach us with these offers?
What percentage of customers approach us for a balance transfer? There is nothing like a balance transfer request that they have to make to us. We will not be able to give you a figure because most customers, they have access to their statement of accounts on their app and the balances on the app. So it depends on who is interested. They would apply for a loan somewhere else and then come back to us, saying that they want to transfer and they are ready with the payment. So. At a very early stage, we would not know whether the person is looking to do a balance transfer or not. However, what we can do and what we do is that we have analytics around, the profile of customers and their behavior, where we are able to predict to some extent, whether they will do a balance transfer. But, based on, we cannot predict that number based on any request or anything that they're making to us because there's no such process. So it's more analytical in nature as to how we can find out whether they are going to do a balance transfer or not. It's more of, you can say, algorithm which can predict whether they will do a balance transfer or not.
So what kind of steps do we take to prevent our customers from leaving based on this analysis?
So we do, we do active counseling. We offer top-up loans to them. We explain to them that the balance transfer is not in their interest because they would have to pay a lot of upfront fees to do the balance transfer. Plus, we also offer them, whenever there are NHB schemes where we have to draw down amounts from NHB under certain schemes. We reset the rate for these customers and then draw down so that they get the benefit of a lower rate. So these are ways in which we address the balance transfer issue.
This BT fees you mentioned, this is payable to the HFS or the bank taking over?
Sorry, you're not able to hear you clearly.
in case the balance transfer is done, the customer has to pay a BT fees upfront. This is payable to Home First or the finance company taking over the loan?
Yeah, no. I'm referring to the fees they have to pay to the company that's taking over the loan. So there will be processing fees, there will be mortgage charges and so on, right? So they will have to go through the entire process right from scratch. So that they will end up incurring a lot of charges. I mean, we don't charge anything for balance transfer. We are not allowed to also, as per RBI guidelines.
Okay. And thank you. And the second question was around what is the average tenure of a loan?
The contractual tenure is between 15 to 20 years. Mostly customers prefer 20 years and some customers take 15 years. So generally it's 15 to 20 years. Effectively, if you consider the prepayments and so on, it comes to around between 6 to 7 years.
Okay. So now, given that we've seen substantial growth come in the last 4 years or so, could we see a heightened rundown in the book going forward as the payments are coming up?
That is, rundown as in natural rundown because of repayment of the loan.
Yeah.
That is generally, that would be a preferred option for us because then the rate of you can say rundown will be slower if the customer is only just making his installment payments and reducing the loan. Generally, the rundown is faster only because of prepayments. If the customer runs down the loan on a normal, natural basis, then the tenure should ideally be more than 7 years.
No, I actually meant natural assets including aside from BT. I mean, given that we've seen a large growth in the last 4 or so years, so as the loans mature, could we see higher prepayments coming up and the book running down faster?
No, we are not anticipating anything like that. Because, we have been growing at this pace for a while and I guess that question will come up only if the pace slows down, pace of growth slows down. I mean, our pace of origination, pace of AUM growth slows down. But then, yes, the rundown on the loans will then kind of overtake the growth. So, but at the pace at which we are growing currently, we don't anticipate any such issue.
Okay. And one last question, if I may. So, I was just trying to understand the penetration scope that is there in the core market. So, what I'm trying to understand is in these core markets, we traditionally targeted these industrial towns around those areas, right? So, how much of a scope is there to further penetrate around these towns, or are we now going to serve more of the a little deeper rural self-employed customer going ahead as we penetrate further?
So if you look at these markets, I mean, if you take any of these markets, which I was talking about, which is either Gujarat, Maharashtra, let's say Andhra, Telangana, Tamil Nadu, the market share that we have currently, is in the affordable housing space is somewhere between say 1 to 3%. So there are still 97 customers out there who are taking a loan from someone else, and we also don't know about the customers who are probably not even taking a loan and trying to just manage with their own funds or borrowing from friends and relatives and so on, which is a very common phenomenon in this space. So which is why the scope for growth is really very huge. So we are first of all not present in all the places. Secondly, we have a low market share at this point, and there is also a hidden market out there where customers are not even aware they can get a loan. So putting all these factors together, I would say we are still very, very long way away from even kind of getting worried about this question. There is a lot of runway for growth available, and I'm talking only about towns, as I think you mentioned that do we need to go very deep to get business, etc. So we are only looking at, we are currently present in 225 towns. We are looking at about 400 towns in the next. So 225 towns is practically giving us about 200 crores of disbursal every month. So if we expand that to 400 towns, it's a fairly linear growth. So a lot of runway available, and we will not have to go rural, and rural markets are also small and the ticket sizes are small. So whatever growth is coming will come from the larger towns.
Okay. Those are questions. Thank you so much.
Thank you. We have the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Current NIM that
Mr. Shripal, you are unable to hear the start of your question.
So just wanted to understand how would the NIM trend for the year for FY23 and the ROA, which is currently 3.9% for the quarter, how do you see that trending for the year?
Shripal, so from a NIM perspective, we are looking at close to 6%, and similar levels of ROA around 3.7 to 3.9% range, depending on how the interest rate volatility takes up from here. So depending on that, we'll land in that particular range.
Got it. And any change in guidance on the loan growth? Because our first quarter has been significantly better. So anything that you would want to change on the loan growth side?
Not right. Not at the end of this quarter. We can relook at it after quarter 2.
Got it. Okay. Thank you so much.
Thank you. That was the last question. I hand it over back to the management for closing comments.
Thank you everyone for joining us on the call. I hope we have been able to answer all your queries. In case you require any further details, you can get in touch with Manish Kayal, who heads investor relations, or you can get in touch with Orient Capital, our external investor relations advisors.
Thank you.
Thank you. On behalf of Home First Finance, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.